Well, hello, everyone, and thank you so much for joining the Benjamin Z. Meller Investor Networking Group. We have a really exciting presentation today on value investing. This is something that is very useful to know and to understand in a bit more detail about how it works for stock investing, not only with publicly traded companies, but we're also going to talk about how it works with privately held companies. So let's begin here with this illustration. A lot of people, when they buy stocks, they don't even know what the stock is worth. They simply do it by looking at charts. They look at a chart and they try to guess what's going to happen in the future. They try to think, well, a newspaper story came out, so the newspaper story was positive, so probably the stock price is going to go higher, so I'm going to buy the stock. And you know what? That actually works in the short term. In the short term, that sort of thing works. But it doesn't work necessarily in the long term, because there's a famous saying by a security analyst. A security analyst means a stock analyst, named Benjamin Graham. And basically, he said that in the short term, the stock market is like a voting machine, but in the long term, it is a weighing machine. And what that means is there's always this movement from market price and intrinsic value. But how do you actually figure out the intrinsic value? We'll be talking about that here, and it is so useful. But first, let's go through the history. Value investing, and this is so important that people understand, it was around a long time before Benjamin Graham and Warren Buffett. But the thing about it is, Benjamin Graham and Warren Buffett, they really made it famous in terms of very well known, where their name is tied to it. Warren Buffett was a student of Benjamin Graham. Benjamin Graham was a professor at Columbia Business School, and he wrote a book. He wrote several books, but one of the books was called The Intelligent Investor. And in this book, Benjamin Graham laid out his ideas on how you could value a company. So, and his idea also was that you should not use the market prices all the time. You should first determine, what is this business really worth as a business? If it were not a publicly traded company and only a private company, how much would I pay to buy this company? That was what he was always looking at, what he was always trying to determine. And he ran an investment fund called Graham Newman. That was actually the name of the fund. And for a long time, Warren Buffett, he wanted to work there. He actually really wanted to work at Graham Newman. But at the time, this was in the past, it was something where he wasn't able to get a job there at first. It was very, very difficult for him. And it's interesting to hear the history of how that all went down. But at any rate, Warren Buffett really applied this in his own investing. And if you're new to investing and you haven't heard of Warren Buffett, he's famous for having Berkshire Hathaway, one of the most successful investors of all time. So now let's talk about, okay, that's great, but how are you going to determine the value of a company? Well, the way that you do that is you do what is called a discounted cash flow projection. And if you look at a company over time, each year, what are the future earnings? Now, this is interesting because you know the present earnings. You know exactly how much money the company made last year. You know how much money they made the year before that, but you don't always know how much money they're going to make in the future. And that's where the skill of investing comes in. You have to project, you have to make estimates, you have to make accurate estimates about what's going to happen in the future. So for example, say that a company had $1 million in earnings this year. You know that last year it had a million in your, say it had 950,000 in earnings, it's within the realm of reasonable that it might have 1,050,000 in earnings this year. But you would make your own projections. You would kind of estimate out many years into the future. Now, the important thing is you don't actually have to estimate in year 28, what do I think the future earnings are going to be? You just do it for the first 3 or 4 years, your best guess, and then you're going to use some numbers to kind of smooth it out. But essentially, the thing that you need is called a discount rate. So you need two things to be able to determine the value. You need an Excel spreadsheet. You need a discount rate. So the discount rate, what is the discount rate? Well, that is something that people hear about all the time. They say, hey, I'm an investor. Oh, great. What do you invest in? I invest in this or I invest in that. But if you're talking about a discounted cash flow projection, you need to determine the discount rate. But you know what's great? It's not hard to determine. It is not hard at all to determine. It is not hard. It is so easy to determine the discount rate. The discount rate, it's determined a lot of complicated ways. But let me tell you the best way to determine it. The best way is decide what sort of a rate of return do I want? If the answer to that is you want a 10% rate of return, your discount rate is 10%, except you use it as a decimal. So you wouldn't use 10 for R, you would use 0.10. Let's say you wanted to get a 20% rate of return. Well, in that case, your discount rate is 20%, but you would plug it in the formula as 0.2. So you would use this formula and an Excel spreadsheet. And actually, it's even easier than that. There's programs out there that can do this for you if you don't even want to do it the harder way with an Excel spreadsheet. But you can, this is not hard to find this information, but this is what you do. You plug that in, and then you're going to arrive at a total DCF, discounted cash flow. It's going to be a number. And let's imagine that that number is 100 million. If the number is 100 million, let's say that the total number of, and what I'm going to say here is important because this is the part that sometimes confuses new investors, common shares outstanding. I didn't say authorized shares. I didn't say total shares. I said common shares outstanding. And we'll go through on another chart what that looks like. But once you've got that, you've got your answer. So if it's 100 million, the sum of the cash flows over time. And then if you estimate with that you're going to divide it by the total number of common shares outstanding, let's say it's 10 million, you arrive at an answer of value per share of 10. So now here's what you do. You know the real value per share according to your projection. So there could be an analyst, somebody that's on Wall Street that's saying that he thinks it's worth a lot more money. There could be somebody else that thinks it's worth a lot more money, but it's your decision what you think it's worth. So if you're going to be an investor, instead of just go around and put your money in index funds, you need to actually know a bit about how to do this and feel comfortable in your own projections. So say you come up with a value per share of 10. Then you can look at what's the market price. Well, if the market price is 4, that's a great opportunity for you to buy that. But what about if the market price is 20? No, you don't want to buy it if it's 20, if the value is 10. So that's basically all that it is. Now, let's talk about how that would work. Let's talk about how that would work if you are dealing with a privately held company. So now we're not going to talk about that, but what if it's a privately held company? Well, we'll go through that in a minute, but I want to also mention another thing with this. So the value investing for stocks is you're taking the true value of the company and you're dividing it by the number of common shares outstanding. That should say common shares outstanding. It says shares outstanding. Then you compare this price to the public or private market price and determine if the stock is priced above or below the market price. Stocks that are priced below the market are buying opportunities. Stocks that are priced above the market, you want to wait on those. So now let's talk about, in a corporation, you're going to find some different terms that are used. When a company is first incorporated, there's the authorized shares. These are the total shares that are authorized by the company. And by the way, this illustration here, this is not the correct number of authorized shares for a new company. This is a bad way to do it, but I just put it up here because I was in a hurry. It's the authorized shares should be much larger. But then you have two categories. You've got issued shares and you have unissued shares. And then from the issued shares, you're going to have it broken down again into two categories where you've got outstanding shares. And that is the number that you use in the calculation. Except this would be in millions of shares, not 1,400 shares. This would be like some little privately held company that somebody set up the wrong way. This is an example of how it would look. They'd go make it with 2,000 shares. They'd do it just like this. They'd have it just like this. But if it was done in a more elegant way, a nicer way, it'd have maybe 10 million shares. So much nicer with 10 million authorized shares. Maybe there'd be issued shares of 7 million. And then maybe there'd be unissued shares, some amount, maybe 3 million that would be for purposes of investment, for other things. But then you're also going to have what's called treasury stock. Treasury stock is where the shares are repurchased by the corporation. So the corporation has the ability to repurchase its own shares, whether it's a public or a private corporation. And when a corporation purchases their own shares, those shares go into treasury. But the number of issued shares is not changing. So now the other thing that can happen is a corporation can also issue more shares. So for example, if they were going along and they wanted, and none of the existing shareholders wanted to sell any of their shares, say that none of the existing ones wanted to sell any of their shares, the corporation could issue some of the unissued shares. So, and actually they can do more than that. They can go back and they can even create more shares, but that's how it works. That's the key thing with it. So outstanding shares, that's what's used in the calculation. Okay, now let's take a look here at a very common mistake, and I see this mistake all the time. You would be amazed how many times I see this mistake. So the best structure, in my opinion, for setting up a startup corporation is to set a very, very low par value. So you set a par value that might be super low, like 0.00001 per share. Now, before you start thinking, that's crazy, I wouldn't want to do that. Let me explain why. It makes the numbers very elegant. So if you've got 10 million shares and you set that super low par value, let's say that you're going to issue maybe 6 million, maybe 8 million shares to the founders, the people that actually had the idea of, hey, we're going to make a company, we're going to do this. Then the other shares are going to be kept available. So then let's just take the example of you issue 7 million shares with this par value. Well, guess what? When the founders need to buy their shares, the cost is only $70. Now, I have seen examples, and I'm not going to name any names, but I have seen examples of where a founder that is new to business may go in and set a higher par value because they're like, well, I want the stock price to be high. I'm going to pick a high par value. It sounds great because then I can say 100 per share. That is a common mistake. And what will happen in some cases, not all, it depends on what geographic location you're located in, is you can end up with a big tax bill, because the people that decide the taxes, they're sometimes looking at, well, what's the par value? What's the value of the shares? And if you set a value of 100 per share, you could be dealing with a very, very high value. But just for fun, look to the right. And I've got something here from that company, Facebook. And this is quite interesting. Look at the par value they put on their shares. Boy, that is small. That is really small. It is small value, 0.0006 par value. So you can see that this is a common practice, and that's something to keep in mind, because a lot of times people, the first time they're making a company, they don't really understand what that par value is. What does that even mean? So just keep that in mind as something to think about. Okay. How do you value a privately held company? Well, here's the great part, folks, and this is what is so nice about this. It's exactly the same. There's no difference, because there's other methods of valuing privately held companies, and I'll describe those also. I don't want to confuse anyone, but with this, what you've got is you do exactly the same thing, whether it's a public company or a private company, because you're making your own estimate. Like, you're a private buyer that's going to buy all of the company. What do you think the company's worth? If you were going to buy something, you'd want to know what it's worth. So that's the first thing that you would do, is you would look at, hey, what is this thing actually worth? And then at that point, once you have a number in mind, then you can determine, okay, this thing I think is worth 100 million. It's got 10 million shares. I think it's got 10 million outstanding shares. So that is, I think it's $10 per share, for example, or 10 euros per share, or whatever it might be. And that's how you do it with value investing. Now, I don't want to confuse anyone, but I'm going to explain something that is another method of valuation that's not value investing, but I want to try to make this clear. So that is value investing. Another common way that stocks are done, but this is not value investing, is people will look at the PE ratio. They'll look at the PE ratio for publicly traded companies that are in the same industry, the same category of companies. And then they'll say, okay, the average PE is, for example, 8, price to earnings of 8. But because that is a publicly traded company, when you go, you can't apply that same PE to a privately held company. It has to be adjusted. And the adjustment is usually about 50%, where you've got, if the company is, it's like in real estate, where if you've got a credit tenant versus a non-credit tenant, it's exactly the same thing, where if you've got it makes it far less valuable because it's privately held, because you lose out on the liquidity, you lose out on a lot of factors that work in favor of publicly traded companies, because they can access financing more easier. It's easier to resell the shares. But value investing is thinking not about all of those things. Value investing is like looking at it as, I want to buy 100% of it. What's it worth? I'm going to hold it for a long time. Because just because you buy the stock at 10 and the market says that it's worth, for example, 20, that's not like something that is going to change anything right away that you buy the stock. I mean, if the stock is overvalued, say that it's trading at 10 and you think it's worth 4, and you pretend you're not doing value investing, pretend you want to do short selling, you try to do a short sale on that stock. That doesn't mean that all of a sudden anything's going to happen. I mean, you could sit there for a long time. It could go higher. because markets can be irrational for a long, long time. So here's the important point with this. The important point is that you need to pick a good discount rate. The discount rate you pick ideally is the minimum return on capital you would expect. So if you want 10%, you select 0.10. And the other thing is that value investing, it really centers on getting in at good prices, and it also involves waiting longer periods of time. So it's complete opposite of trading. It's not trading, it's not day trading, it's not even related. It's another world compared to that. It's a strategy of wait and hold, while as this quote from Benjamin Graham says, in the short run, the market is a voting machine where it's a popularity contest. But in the long run, it's a weighing machine. So great example is you've got some tech company that everybody loves and everybody is thinking it's going to make so much money. Everybody buys the shares go higher. The people that made money are getting excited. They're talking about how it's a great company. More people buy the stock. And then the report comes out saying no earnings. And then the management team explains, it's just around the corner. It's going to be soon. It's going to be soon. We're going to get more earnings. We've implemented changes and people get excited and they buy the stock again. And then the next year rolls around and there's still not good earnings. It's still losing money. And then the management team is explaining, no, it's going to be great. We've implemented this and we're about to get a big order. And, maybe the stock creeps up a little bit more. But then after a period of time, all of a sudden that track record of no, after a while, it results in that stock price going down. And when it goes down, it often can go down very quickly. It can be an overshoot as well, because that's just the nature of the game. It's just really the nature of the game. It's definitely relevant. So that is it for the presentation. I'm going to go through two quick reminders and one other thing, and I'm going to stop the recording, and then I'll be happy to take any questions. And while I'm doing this, I also want to direct your attention, please, to the chat window. Please notice the chat window. There should be a link in the chat window where you can put in some information on yourself, or if you've been to one of the meetings before, you can update anything you want. This list, you'll get a copy of it, but I also share the list with some other investment clubs that I'm involved with. And you might get a pleasant surprise where if you're looking for capital or you're looking for a deal, whichever one you're in, or if you're looking for both, just put it on there. And then we can help with making some connections. You are also welcome to contact anyone that is on that list. I encourage that. They put their name on the list because they wanted to be contacted. They wanted to make some business contacts. So reach out to them, reach out to each other. So very good on that. Okay, so the reminders. Please take the time to fill out the sign-in sheet. So important. You'll get that emailed to you in the next 24 hours, but I got to have your email address. Please put it on there. Then if you have any friends or colleagues that you think would benefit or be interested in this, that they want to meet more investors, they want to learn more about investing, please feel free to invite them to come to the next meeting. They can register on Meetup. They can join on LinkedIn. They can just on LinkedIn search for Benjamin Z. Miller, or you can just give them the link. When you get the link, you can just give them the link. And then one more thing, I also have, and this is so exciting, I also have a mentoring program. And let me describe this mentoring program and how, if you're watching this video and you've ever thought about becoming a more skilled at investing, whether you are a total beginner or whether you're an experienced pro, I can help you. Basically, I can offer personal introductions to my business contacts. I can help you find money for your deals. I can help you evaluate markets. I can teach you also how to evaluate markets, how to evaluate deals. I can show you some different methods on how to negotiate and structure transactions, all sorts of benefits. Do not be hesitant to reach out to me if that sounds interesting. It would be my pleasure. Okay, so we are finished with that part. I'm going to stop the recording, and then I will be very happy to answer any and all questions. Come one, come all. Any questions, I welcome.